So welcome to this webinar Market Thursday. We are December the 3rd and I'm in London. It's nice and raining and it's cold. I hope for you it's better. Last time we spoke was 2 weeks ago. In between we had Thanksgiving. So for the US viewer, I hope you had a good Thanksgiving. And let's start with, as usual, looking at my background, what I've been doing over the last 20 years. So I started to trade in 2000 as a cash equity trader working for Pierre Charon Gestion. And I worked there for 4 years. Then I joined a hedge fund here in London from 2004 to 2008, both on their long only product, then on their long short product, where we were managing at the top roughly 750 million or a bit less on the western part, and 3 billion for the overall company. In 2009, I joined Infinity Capital Market, where I worked from 2009 to 2018 as a prop trader. And in 2018, I launched my own mentoring program. Last year, I launched the 4x4 video series. And in 2014, I started to do some mentoring program for another firm. So what are we going to be covering today? As usual, we're going to be doing a bit of situation across asset classes, looking at stocks, credit, commodities, FX, doing a market review. We're going to be looking at the recent performances and looking at the possible catalyst. Then we're going to be jumping into the world PMIs, the ISM Manufacturing in the US, and then looking at the central banks. So, as usual, this is something that we have been doing since September, at least, looking at all those drivers. And we're going to have some central banks update in the month of December, both with the Fed and the ECB. So that is important in terms of drivers. We get the biggest expiry coming of the year on the 3rd Friday of each month of December, which is on the 18th of December. We get some index rebalancing as well, so that this is more for special situation active trading. And we could have as well, at the end of the year, of the calendar year, some asset reallocation. Why? Because we know that Biden might want to increase some taxes. And if it does so, you might see some market participants taking some profit out of the table, keeping in mind that most asset classes have been up nicely this year. And to avoid paying more taxes next year, some of those market participants will be keen on selling. So that are some of the factors that we'll be looking in the next month. As we're in December, obviously, we are looking at 2021 asset allocation. And I will try to do, like I did in January of 2020, a webinar probably mid-January about 2021 of where to look at and asset allocation, keeping in mind that when you look at December, when in December you look back in January, sometimes you find out that some of your calls have been horrendous, and some of your calls have been doing okay. But that's part of the game, and that is always nice to do. So what about we start with asset class performances? So this is the year-to-date asset performance. So this is the chart with the Bitcoin that I included recently. So let's go into the next slide, where the Bitcoin is not distorting all the performances. So for all the Bitcoin and cryptocurrencies fan, we all know that this is the best in town, up 170% almost. But if we look from the left-hand side, looking at stocks, we can see that the Nasdaq is pretty strong on the year. We have as well the S&P doing fine. So stocks across asset classes, stock across countries have been doing very well. If we look into the purple now, dollar has been weakening. Dollar has been weak on the year, down roughly 5% across and against most currencies. Then jumping into commodities with gold and WTI. When we look next phase into technical analysis, we'll be looking more into other ones. But gold has been up 20%, down 10% from the highs, and WTI has been recovering from the lows and is now trading around 44, 45. If we do the same now on the week to date, so from last week, there has been a risk on that started after the election, and that has been confirmed since then. So November was a very, very strong month across asset classes slash or except gold. So we had strong performance, and last week as well, where the S&P 500, and sorry for the noise in the background if there is, but London is still alive. So Nasdaq Composite doing well. So you can see that we are roughly 1-2% up, despite over the last couple of days or more some consolidation. DXY, meaning US dollar, similar picture, US dollar. So that was the prices as of yesterday. Dollar has been weakening. Spot versus the euro dollar is versus the euro is like 120, 150. So weakening, and there has been some acceleration in the weakening. Gold bouncing from the recent sell-off, and WTI again, instead of trading around the 40, is now trading around the 45 level. So what is interesting is the US dollar is really keeps on weakening. So these days, this is mainly stocks have been fairly quiet versus the other asset classes. So it's all about the dollar these days, or should I say, not only about the dollar, but the link between currencies and the bonds. So there has been a trend towards risk on recently, and the flight to safety is off now, meaning that the dollar has been weakening. The COVID, the vaccine, the world probably looking better in 3 to 6 months is making the dollar weaker. So with risk on, there is less need for flight to safety. So into the next slide, we're looking at the year-to-date sector performance. So for the newcomers, this is sector performance for the 11 sectors of the S&P. Energy, despite bonds, is recent bonds from 30% from its lows, it's still down 35% plus year to date. Financials as well have been struggling. If you look at JP Morgan, if you look at Wells Fargo, they have not entirely recovered from the lows. And on the other hand of the spectrum, we got IT, consumer discretionary, which is massively helped by Amazon and the other winners like the healthcare. But clearly, the big winner is is IT, the Nasdaq, the QQQ, everything that is technology. On the week to date, energy has been struggling a bit after its massive bounce. So it's trading around 38 now, with the lows around the 27th, I think. And at the bottom of this chart, you can see that healthcare and IT have been not performing recently. So there was a lot of rotation. There has been the start of rotation. Rotation means the past winners, the past sectors that were benefiting and the best were struggling versus the losers. That started at the start of September, where we started to have some rotation, and there was massive rotation after the election with the COVID vaccine. So we had 2 Mondays with massive rotation, where QQQ, Nasdaq underperformed the overall market, and anything that was kind of the laggards really started to move. So we had value outperforming growth. We had all the small mid caps outperforming big caps, and over the last couple of days, actually, I think it was Monday or Tuesday, all the FANG stocks outperformed massively, again by 1 to 2%. So question is, as always, are we going to see a clear rotation? That started 3 weeks ago. Those kind of things don't go on a one-way traffic. The only thing that we know is there has been a lot of pain in November in the market. I mean, there have been some winners as well because the market is up, but people that were positioned as they were over the last 3 to 6 months, suddenly this reversion, maybe to the mean, or at least this rotation, has been painful for not only retail investors but the professional investors as well. Next slide. Going from those sectors into the bonds. So the bonds now, let me here trying to highlight here. If we look here, the whole bond market. So bonds are selling off, meaning yields are going up. US, UK, Germany, Italy. It is very true for the US, where we are trading now close to 1%. That is the same as for the dollar, with the less necessity for flight to safety. Investors are dumping their US dollar and their treasuries. If you look at the drivers now and the euro dollar, I think now it's less obvious. So that's something maybe we're going to discuss today. For the VIX, looking at the implied volatility, this is not the absolute indicator for volatility, but that is helpful. Now implied volatility is at 21% for the next month. Year to date, we started at 13%. We are not moving that much. We are the low range, very low range that we had. You need to keep in mind that historically we are trending around 19%. You can't do technical analysis on the VIX. I think this is misleading, but that gives you the overall picture. On the top winners and the top losers, we get names like Moderna, BlackBerry. What is interesting in some of the big winners, like actually Moderna, Palantir, NEO, the names that have been pushed massively by retail traders to options, have recently reached some top. So we had the market going higher, but in the meantime, the names that were on steroids struggled a bit. So if you think that they are leading indicator of the leading indicator, that might be a sign. And on the other end of the spectrum, so if you have Palantir that is down 22% week on week, it's just that is you need to put everything in perspective, because months on months it is up more than 100%. So a massive move. What you want to be looking at is always trying to generate ideas from those movers and trying to understand what is moving in the market. So again, I find quite interesting that the S&P has been making new highs, but the recent leaders of this retail have been struggling since the, let's say, the last 10 sessions. Next one. So this is a special situation, and I think there is an upgrade coming this morning from Goldman Sachs. I'm not putting Tesla not only to be making some noise, but I think more interestingly, for all of you who have exposure to the US market, you know now that Tesla will be included in the S&P 500 on the December the 18th, sorry. And that's going to have massive repercussion, because Tesla now is a 500 billion plus market cap company, meaning that all the mutual funds suddenly need to have exposure. So usually mutual funds do it on the day, on the Friday, but looking at the size that they will have to be buying, there were some talks that the committee will ask or give access for those mutual funds to do it over a couple of days. The decision has been made. It's going to be only on Friday. So it's a pure special situation. 3 months ago, the committee said no for Tesla inclusion. That means you're going to have forced buyers based on their forced exposure to Tesla on the Friday. And on the other hand, people will have to sell the 499 other shares of the S&P. So what does that tell you? More or less that on top of having a very volatile year for 2020, the 18th of December could be extremely volatile at the end of the day of this Friday, and as well coming into the next Monday. So those are the things that you need to be looking if you're looking at special situation. This is something that I teach in the 4x4 video series, and I strongly advise anyone when we do the mentoring to look at those catalysts and special situation. Why? Because Tesla is so big that it's totally unusual. It's more than a single stock or a single company that will enter the S&P. This is just massive and it's going to have repercussion. The catalyst, again, I like to be looking at what's going to happen in the next 10 days. So this is the calendar for tomorrow until next Friday. Tomorrow we're going to have a lot of noise, as always, with the NFP. So NFP is always, when you start as a retail trader, you're always fascinated by NFP. Then you realize very quickly that it's super hard to trade this volatility. You realize that the numbers are extremely volatile, and then you finally understand that this is a lagging indicator. So we know that the economy, US economy and the world economy has been struggling big time. That many people lost their job, and since then the employment market has been recovering. So that means slowly but surely, depending on the speed of the recovery, we're going to see those jobs coming back. So tomorrow, again, a lot of noise. I'm less fascinated by these numbers than I was 20 years ago, but this is what it is. So next year, and even next week, what we're going to have in Europe the ZOO economic sentiment, which is giving you a bit of color, but the German economy. More interestingly, on the 9th, we're going to have the Bank of Canada rate decision. In the 10th, so next Thursday. So I don't know at what time I'm going to be doing the webinar next week. Probably not at this time, because the ECB will come with their expectation for 2021 and their decision. And there is a lot of expectations coming into it. So we're going to discuss that in the next few slides. And then on Friday, we get the University of Michigan. So those are the drivers that we'll be looking. So next week, ECB, in 2 weeks' time. After that, we have the Fed coming as well. What about, instead of going to the world PMI, we go into technical analysis and price action, starting with the VIX. Okay, so this is what I discussed before. It's not about doing technical analysis on implied volatility, because you can't really do that, but just to have a big picture. So we are now at 21% on the VIX implied volatility. If you look over the last 10 years, you could be saying that the range is rather between 10 to 19. And again, since its creation in 1991, we are trading around 19%. So what about the price action of the S&P 500? So again, now the struggle is, when you go up, where could it be stopping? If you're long, well, you should be taking profit. And if you want to go short, what is the time? At the moment, we are going up and up and up. So no need to fight. There is some consolidation. I know that many people come to me and say, look, Greg, we were up 10% or 15% in November, but you have the end of the calendar. You have ISM looking good. You have central banks that are keen on putting tons of money still in the system, and we have an agreement from most countries that we need to have more fiscal stimulus. So 12 months ago, when you were saying to people, we're going to be doing fiscal stimulus, they will tell you, oh no, we can't do that because there is debt. Whereas these days, we kind of saying, oh, because of COVID, we can do whatever we want, and let's print and do more. So you have many factors for the risk on and equities that might push the market higher. Always hard to call a top. I've tried in the past. I've been wrong many times. So I'm strongly telling you, be careful on trying to call the top. The NASDAQ, so let me go into the logarithmic chart for the NASDAQ. So this is the chart of the NASDAQ. We are making top. And then we are going above this range. So The speed of this move has been pretty strong, to say the least, but at the moment it carries on. Russell 2000, why small and mid cap? We can see that we broke an important resistance that was 3 weeks ago. So important level. If you are looking at technical now, a resistance could become support. So that's something to monitor if we have a correction. The DAX is coming to a very important level. So in Europe, the DAX, which is the strongest index, is making recent highs. We have not fully recovered, but we are at an important level. Another one that I like to be looking at is the Philadelphia semiconductor. We know that the whole world is moving into semiconductor. Semiconductor have been extremely strong. The trend is still very strong. So quickly now, let's jump into currencies. So this is the big picture of the euro dollar. I've been saying it over and over the last 3 months when people come to me and say, look, the dollar should be stronger. And I've been telling people, look at the chart. The chart is telling me that the dollar is going to be weakening. And there has been confirmation recently. So if you do a bit of macro, you can clearly say that on one hand, US economy is doing better than Europe, for instance. You can say as well that the US 10 years, the spread between the US 10 years and here, and the German 10 years, which is the US Treasury versus the Bund, let me give it to you here, is widening again. Okay, so let's put the chart, it's widening again. So the carry trade is in favor of the US dollar. But, and there is a big but, one of the reasons why we went down massively is because of the COVID. And the COVID, meaning flight to safety. When the world is under massive stress, the world goes long the dollar. And that is what has been happening since June. The dollar has been weakening massively. So people who have been calling a stronger dollar have been pretty wrong, and I'm not trying to put finger at people. I'm just saying that the price action so far is for the euro, dollar going this way. Having said that, I think if you start to look at the macro call, it's harder to justify. If you look at the long-term picture, yes, you can argue that 130 is in play, around 130. Still, you don't want the euro situation to deteriorate further. I think there is a catalyst, which is the Brexit. So if you look at the sterling, dollar sterling, Brexit is going to happen. Normally, there are talks that if we don't have a deal tomorrow, we might have a deal this weekend. So that could be something, and that will be something to monitor. When we look at sterling, we should be looking at well as FTSE and FTSE 250 and all the stocks that have exposure, because the equity market will be moving on it as well. So currencies, again, across the board, where is my DXY? The dollar has been weakening. It's not only because the US economy is doing worse than the other economies. It's more like a risk on, risk off. And as there is less needs and there are more hopes that the vaccine is going to come, people are going are selling some of their dollar exposure. If we look at now the bond market, looking at the 10 years, again, if you that's the same here. There is less need of a flight to safety, meaning people are hand in hand with selling the dollar. They are selling their treasuries. When you sell the treasuries, when you sell bonds, that means the yields are going up. Again, I don't know if it stopped at 1%, at 120, at 140, at 160. And that is true, Dean, very true. That is something that we're going to be covering later, that the Fed is printing twice as much as anyone else. So that's something that we're going to be covering. So yes, they are printing 3 trillion instead of 1.52 trillion for the ECB. So that is a very fair point. But if you think about the big picture, if you look at the balance sheet of the ECB or the Fed versus the GDP, that is very similar. Okay, and if you think about the fiscal stimulus or the deficit, they are very similar. So I think it's more a question these days as well of risk on, risk off, and flight to safety. Because if you look at the headline, the fiscal stimulus in the US should be much, much lower than what were the talks a couple of months ago. So a couple of months ago, even if we knew that there will never be a deal between Pelosi and Trump, that was quite funny when we had the 2 trillion talk or 3 trillion talk. Now they are talking about a 1 trillion fiscal stimulus, which is still big, but it's only now 5% of the GDP. So if we carry on and looking at what I discussed, the yield curve. Sorry for the chart; it's a bit of a mess on that platform. But there is still steepening of the yield curve. Steepening of the yield curve tells you as well that the expectation of a better economy are coming, and as well that inflation might be coming. So that's something we discussed before. On the inflation coming, I think the call is from 2009 to 2020, we did monetary stimulus. Okay, so that was mainly asset inflation. Whereas now we might be moving for quite a long time from monetary stimulus to fiscal stimulus. So we already did some fiscal stimulus, but we could be doing even more. That's the case in the US, as well in Europe. If you do a fiscal stimulus, you have a chance to see inflation. You might have a chance to see inflation coming down the pipe. Always hard to know, especially after 2009, where you could have argued that QE will bring a lot of inflation, and actually inflation through PCE or CPI never really showed up. But again, if you look at the correlation between 10 years and inflation, when inflation goes up, you need at one stage yields to go up, even if the Fed and the ECB probably are keen on having higher inflation than usual. You still have the risk from now in the next 5 years to see inflation going up. And that means it's going to have a repercussion for the bond market. Quickly, after doing bond credit markets, I would like to discuss gold. So that's the chart of the gold that we discussed before. There was so your 1850 is no resistance after being a support. We are getting close to it as we have bounced recently. For many charts had very interesting breakout level or breakdown level. So that's for the WTI, that is 44. Another one that is extremely interesting is the copper. So copper broke the 332. So let me give you the long-term picture. Why it is 332? That is the picture. And if you look even more, so you can argue that copper has a long way to go. By definition, with the weakening of the US dollar, the second derivative of one of the components that has been affected has been the commodities. So the commodities rallied nicely. And as well, emerging market have been doing very well. So emerging market, if we take EEM, I don't know where's my EEM, I don't know if it's somewhere, let's put it here. So emerging market have been doing very well. So there is a lot of correlation between all those names. Commodities, I think I mentioned that through several mentees, and I mentioned that before when we look at, what was that, FCX on the numbers. Clearly, commodities have been doing well. Now, coming back into the 2021 expectation, it feels like the consensus is for commodities to keep on doing very well. So be careful when the trade that was an outlier trade becomes like the consensus trade coming into the new year. So that's for the commodities. Sorry if I'm missing some. If you get some question or if you have some suggestion for the next webinar, just let me know. And then moving then into some single names. So as I said, Freeport is reaching important level. So that's the 25 level, 24, 25 level that we had. The move has been quite strong, to say the least. Some of the names like GM, which is close to this 1080 and touch this 1080 that I mentioned before. A name that I'm looking and we're going to be discussing through the ISM Manufacturing, which is Corning. Again, this is for you to do your research. There is Baba that broke down. You do have like Zoom that broke down. Some of the names that were extremely active and were the leaders that are a bit struggling. So we might be in the search for new leaders now. Again, if you look at how well people that were long technology software have been doing, this year has been phenomenal. So well done to them. But it's not a question of sticking to something forever and ever, because sometime it's going to turn. And that is what we want to be looking. So let's look back into the slides, if I manage to do it. Yeah, we are back to the world. So let's start with the world PMI. So at the start of every single month, as you know, we get the best leading indicator, which are the ISM and the PMIs. So here we are looking at the JP Morgan Global Manufacturing PMI, which is bouncing nicely, which is at 53.7. It is bouncing nicely. Interesting comment, November, so slow globally, manufacturing output expand at the fastest pace since January 2018, and at one of the best growth rates over the past decade. So manufacturing is doing very well. We know that if you look as well at the ISM Manufacturing, that exports are doing well. So in Europe, for instance, Germany is outperforming the rest of Europe. Why anything that is a link with the exports and the reopening of the world economy has been doing fine. So if you look at Brazil, if you look at China, if you look at Germany, if you look at South Korea, those are the places that have been doing fine. If we go into the next slide, that is a confirmation here, where we got Brazil, Germany, Taiwan, USA, the big winners, where the strongest performing territories were very often emerging markets. I think what is interesting is that is something that you could be building. Taking all the PMIs, you can do an emerging market PMI, which is GDP weighted. So that's something that I do every single month. And by definition, emerging market is 50-60% China. So the same as the XY is massively towards euro dollar. Emerging market EM is massively skewed towards China, but is making strong new highs. And that is why as well, if you do the correlation between this ISM and the EM, you will see that there is a strong correlation. As always, a lot is, I don't know, a lot is probably not the wrong word, but many things have been priced in now. Be careful coming into 2021, where people go into 2021 and looking at what has been performing nicely in 2020 to tell you that over the next 12 months is going to be the same story. So if one sector is doing well in Q4 2020, they will tell you, oh, you should be long the whole quarter or the whole year. Unfortunately, this is not the way it works. And very often what you have is you're going to have big move in January, and you can have as well big rotation in January. So be careful on the 2020 is going to be X or is going to be Y. US, sorry, let's go back. ISM Manufacturing. So this is the full picture. We are not as strong as we were in October, but the numbers are still pretty good. 65% on the new orders, which is very strong. The prices are the same. So there is inflation in the system. Employment was not great. So easy to tell that tomorrow we might see bad NFP numbers, but what is interesting as well, as I mentioned, is exports are doing very well. So when exports are doing well, it means the overall economy, world economy is doing better. So if you take the past relationship between this level of ISM, which is at 57.5, and what US GDP growth that you should have, that should be around 4.3% GDP growth on an annualized basis. So if we scroll down into the ISM manufacturing, looking at the sectors, I think it's I mean, if you have been looking at this report a couple of days ago, you know it already. But or anything that is cyclical is doing fine. Okay, so but apparel is showing pretty nicely on the new orders and on the sector normal level, and interestingly, you can see that is confirmed by the comments that we have here. With the primary metals, our business is booming as many customers need products ASAP. On the other end of the spectrum, printing and oil have been a bit struggling. As we discussed before, since June onwards, it's going to take time for the oil sector to recover. It's going to take time for WTI backlog, or should I say reserves, to be swallowed by the market. So we're going to have going forward a bit of a struggle. I think I'm looking at some sectors, some industry. You have some mentees here, so I know you're following today. I think one of the interesting one is the non-metallic products. I started to look at it. There are names like Corning, as I mentioned. Chemical, we already pushed for that in last summer, in July, August. Be careful on how much has been priced in. Many things have been making new highs. So that is for the ISM manufacturing sectors. Let's quickly coming back into the ISM manufacturing. So today we have services going out this afternoon in the US. This morning we had the numbers in Europe. We know that services across the world have been suffering much more than manufacturing. Why? Because we have been forced to stay at home. And in Europe, the numbers came down quite a lot. I think it's in the low 40s for most European countries, except Germany, which is at 46%. So that means we're probably back to recession in Europe, not as bad as it was in March to May or June, but still. And in the US, with the election and the possible COVID cases coming up again, that's going to have a repercussion. So overall, looking at this picture, you have manufacturing that are telling you that the world is better. Many parts in the world that are doing better. Right now, if you look at the numbers that how the economies might be doing, they might be struggling a bit. And this is why in the US, for instance, they want to push massively for a fiscal stimulus because you need to fill the gap between the moment we get the vaccine, which overall is going to be in 3 to 6 months time for everyone to have it. And now, so you have this window where you don't want to worsen the situation, because a situation like the COVID is fine enough if you get a V-shaped recovery and you recover quickly. Otherwise, the longer you stay, meaning that for companies, it's almost impossible to recover from that. So services this afternoon in the US, the picture from Europe, we knew it already that it was for another recession coming. So we get the Fed coming in 2 weeks, 15 and 16 of December. That means on that week it's going to be busy because Tuesday they are meeting, Wednesday you get the outcome, you get the press conference at the end on the night for us in the UK. And then on the Friday you get the biggest expiry. And normally between the biggest expiry and into the new year, you don't have much unless some portfolio adjustment. But most people, most mutual funds will, sorry for the noise, will take this weekly liquidity, which is probably going to vanish afterwards, to close some of their position. So what are the expectations from the Fed? I don't think that they will expand the asset purchases, but they might modify the program, the composition of the program. Fed has been talking a lot and putting a lot of pressure on the politicians to increase the fiscal stimulus. That is, this meeting is going to be important. I like to look, as always, at the euro-dollar futures to see what are the market view of what the Fed is going to do in the near future. So here it is from December 20 to March 2023. And more or less you have no expectation from the Fed in the next 2 years. I think it starts to move a bit from end of 2023 to 2024 or 2024. But really keep an eye on this, because expectations are for absolutely nothing for the Fed to do. In the meantime, we could see some inflation, or if you think that you have a V-shaped recovery, you'll have to see inflation. As always, the Fed say we are keen on running the inflation higher, but the Fed is making part of the decision, but the market is making a lot of the decision as well. So it might push the Fed to do something if actually we are doing a V-shaped recovery. So as Dean was saying in the chat, so this is the Fed balance sheet where we are up 3 trillion since the end of February 2020. So 3 trillion. So if you put everything into perspective, $3 trillion US versus a 20 trillion US GDP, that makes 15%. So between March and now, the Fed has been increasing a balance sheet by 3 trillion. So that could explain as well the weakening, obviously, of the US dollar, but you need, as always, to do a relative and see what is the picture from other countries. And here, ECB, so we have the ECB meeting next week. I think not only because I'm European, but there are many more things that are expected coming into this meeting. No rate cut. I think now with negative rate cut, they now realize that going lower, it's not necessarily helpful anymore. They are talking about, sorry, it's a bit some funny language, but they are talking about tweaks to the PPP, which is the Pandemic Emergency Purchasing Program that they started in March. They increased it in June. There are some talks that it could be extended again, because normally market were expecting so far to the end to be around June next year, and it could be until December next year. There might be some change in the APP, which is the Asset Purchase Program, change in the LTRO overall. And I think what is interesting is the fallen angel debt. As you remember, the Fed did the same in March. They were very quick to realize that names like Ford were not part of their purchase, their asset program, fallen angel debts mean that because of the COVID, some of the companies saw their ratings coming down and were not the deterioration to junk bond were making the purchase from the Fed not possible, and the Fed decided to tweak a bit the condition. I think what the ECB is gonna say is they're gonna have to discuss the euro level. Okay, so next week at 1:30 UK time. This is why I can't do this webinar at the same time. With the euro dollar at 121.50 and the euro getting stronger and stronger, this is not necessarily what you want to have for the European economies, keeping in mind that a country like Germany exports a lot, and when the euro is strengthening, that is not helping exporters. So you can be 100% sure that there's going to be a conversation around it. So be ready for some moves around this ECB meeting. Looking back at the balance sheet, as Dean was saying, since March balance sheet is up by 1.8 trillion euro. So if you adjust from the FX, you can argue that this is $2 trillion roughly up for the ECB versus 3 trillion for the US. So overall, that explains as well why the dollar has been weakening. The more QE you do normally at one stage, the more it's going to impact your economy. Quickly, going into the 4x4 video series, this is my education. This is what I offer. This is a comprehensive online video course. I this week changed a new website. So we got a new website. I think the experience for users is much better. I'm using platform like LearnDash, and it's very helpful, I hope. So that was really for you to have a better user experience. You're gonna have 40 plus videos, around 30 hours of footage, 50 plus Excel spreadsheets to build your infrastructure. The feedback so far for the user is really good for the last 12 months, but at least since we launched the new website recently. If you want to look at the website, you're going to have some testimonials, and for more information, obviously you can go directly on the website. There is a second product that I offer, which is the mentoring program, which is for more advanced trader. Either you do it with the 4x4 before, or if you think that you are an advanced trader enough to get all the basic to make the most of the mentoring program. This is 12 weekly one-on-one online sessions over 3 to 5 months, where similar to the 4x4, we're going to be building your infrastructure, but we're going to be learning in real time to be trading your money. So I'm going to help you to manage your own money. Where we're going to be doing macro, we're going to be top-down, bottom-up active trading in special situations, very similar to what I do. And the idea is to consistently generate ideas, to have returns between 5 to 15%. If we could start there, that would be brilliant. And for some of you as well, if you want to have access to the industry, building your own track record. Because it's Christmas and because it's December, I'm offering 25% discount for the 4x4 video series on both the 2 months access or the 12 months access. So you can use this voucher holiday 25 until the 31st of December. That is for the new website. This is for Christmas. And this is maybe for those of you who are struggling to help you. This is about it for today. What time is it? Maybe we can do 2 or 3 questions if you want to. If you got any question about what we covered today, or some catalyst, or some things that you want to discuss. Otherwise, I'll try to do a webinar next week. Probably not at the same time, maybe in the evening. I'm not sure when. And if not, I'll be looking into in 2 weeks' time, that is for sure. A question, Greg, how do you look at target prices recommendation published by brokers and analysts? How should we look at this when making trading decisions? So analysts, by definition, the consensus is always bullish. Okay, so when you look at consensus, there are 2 things. Even if the target price is below the last, analysts will come with a neutral or a buy. Secondly, by definition, analysts are working for investment banks or brokers, and 99% of their clients are long-only people. So they want to have the market to go up. So they want to come with long recommendation. Plus, by definition, if you are a broker or if you're an investment bank and you want to do a deal with a company, you're never going to come with a sell rating. If you come with a sell rating, let's say you are Goldman Sachs and you want to do business with Tesla because you want to be their main banker. Are you going to come with a sell rating with Elon Musk to tell you, no way I'm going to do business with you because you came with a sell rating? So what you do, sometimes you get a tendency of putting a buy signal. I'm not saying that the call today was to do so, but actually in the past, if you look at Tesla, there are couple of names of banks that have done exactly the same to get some deals right after. So the way we look at the consensus is to get an idea, feel of what the market is pricing, what are the expectations, and as well if there's a huge delta between the last price and the consensus, the target price. What I like to do when I do a bit of research, and this is what I do when I call for the mentoring, I said to my mentees, you need to look at the you need to look at the consensus, try to find the latest consensus that came out, and Google the name. So let's say, for instance, today we get Tesla with Goldman Sachs. So you Google Goldman Sachs Tesla, and they're gonna give you the 3-5 reasons why they think that Tesla should go to 750. So for you, if you're a newcomer going into Tesla, that's gonna help you massively or speed up your process, because literally in a Google time, you're gonna know 3 to 5 catalysts that top analysts have been looking at. That doesn't mean that those are the only catalysts or they are the best, but this is what you could be looking quickly. What I like to be looking at as well is looking for the contrarian call. So try to find out of your 10, 15, 20, 30 analysts that are following the stock, the company that is coming with a contrarian call. Not just for the sake of looking at their price target, but literally to understand why they are saying so. So the consensus, the guy from JP Morgan is saying the same as the guy from Morgan Stanley. What you want to have is the analyst saying something different, because this is where you're going to find the catalyst that could be different. So this is always that I look at, and this is the same as when I do the mentoring. I say to my mentees, when you listen to the earnings call is always the same. So the first 5 questions of the earnings call from the analyst, they're always the same analyst. Hello, this is Greg from JP Morgan. Hello, this is Nick from Goldman Sachs. So you're going to have the 3-5 top guys. They're always the same top analyst. And then if you wait a bit, you're going to have the small analysts from smaller firms. And those smaller firms, the only way for them to get commissions from clients is to have a call or value added. By having value added, they need to ask questions that are different from the consensus. So if we look at Tesla, we'll say, oh, what's your exposure to China? What are the margins? Are you going to be free cash flow positive? And the guy working for a small broker will ask a question that is different, hoping that his call is going to come out of the mass. So that is the way I look at target price and recommendations. As well, if you're really into analysis and working as a pure analyst, you can do some DCF model. DCF model, keep it with a pinch of salt, because I discussed that before, and I discussed that more in detail in the 4x4. There is a lot into the discount factor and what's the end price of your project. So that's a bit of a problem here. Okay. So hopefully you like the new website. Hopefully you're gonna subscribe to the new account that I have on Twitter as well for following Dupont Trading. If you like what I do, please forward tweet. That is really helpful. Thank you again for following and bringing some good questions. And if you want for me to have to discuss some other topics going into new webinars, please send me an email at greg@duponttrading.com. And either we will see each other in a week or in 2 weeks' time. Thank you, all of you. Bye-bye. Have a good day.